companies control their inventory? What strategies or techniques do they use to control it? Glad you asked. So in this video, we will discuss a few approaches or strategies that companies use to control their inventory that include economic order quantity, or EOQ, economic production quantity, or EPQ, reorder point, ABC analysis, vendor managed inventory, or VMI, and just-in-time, or JIT, and just-in-time 2, or JIT 2. So economic order quantity and economic production quantity are just models that companies use to optimize their inventory levels. So when it comes to ordering inventory, there's a balance at play. On one side, we have what we call ordering cost, and that's going to be any cost associated with ordering that product. That can be labor, any shipping cost, or any cost that the supplier may have associated with ordering a particular item. And then on the other side, we have what we call carrying cost or holding cost. And that is usually storage cost or the cost to the company just for having that inventory, whether they have to pay for additional storage, or again, remember, when it comes to inventory, or more so when it comes to cash flow, inventory is very important. Company does not want their cash tied up on the shelves. So there's a balance at play of optimizing inventory levels, and that's where economic order quantity and economic production quantity comes into play. So economic order quantity, I'm not going to go into the math and the details of the formulas in this video. I just want you to have a general understanding of how they're both used by companies. So generally, the only difference between EOQ and EPQ is EOQ is a formula that will be used for items that do not require any production. So these are usually finished goods. EPQ, economic production quantity, are those that will be used in production. So easy to remember. If you're talking about an item in which you will produce something, EPQ is the model to use. And if there's something that will not be used in production, then EOQ will be used. So let's look at some assumptions related to both of these. Before you can use these models, there are a few things that have to be in play. So for EOQ, the first assumption is only one product is involved. You can't do this with multiple products. You have to apply this model individually to each item. Second, annual demand requirements are known. So you have to have a general idea of what the demand is like for that particular item. Third, demand is spread evenly throughout the year so that the demand rate is reasonably constant. So this just says there's no seasonality associated with that annual demand. So you want something that is going to be constant throughout the year, not peaks and valleys over the span of the year. 4, the lead time does not vary. So your lead time needs to be consistent, right? For you to know the order pattern. And since I haven't defined it, lead time is just the amount of time it would take for that order to be received from the time that it's placed until you receive it in your facility. 5, each order is received in a single delivery. Again, this is not batching deliveries together. We're looking at this order by order. And then lastly, number 6, there are no quantity discounts. So the quantity discount model is the more you buy, the more you save. We see that when we go to stores, for example, when we buy paper towel. 2 paper towel rolls may cost you $4. You're paying $2 each for each roll. But then you may be able to get 8 for $6. So you're not paying as much for those rolls because you're paying less money. So these assumptions must be true for the economic order quantity to work. And for EPQ, some of the assumptions are the same and some are different. 1, only one item can be involved, just like EOQ. 2, annual demand is known, very similar to EOQ. 3, has a constant usage rate. Again, very similar to EOQ, to where the production of this item is pretty consistent and there are no peaks and valleys or seasonality associated with that. 4, the production rate is constant. Again, producing at a consistent rate and not in increments or periodically, but we're producing consistently. 5, the lead time does not vary. Again, we need that lead time to be consistent for that product. And 6, there are no quantity discounts here either. Again, quantity discount model, the reason it doesn't work with that is because it throws the cost off, right? And this whole idea is to balance carrying cost and holding cost to optimize inventory levels. So we have to make sure these assumptions are true before we can apply these models to items we're using in production or EOQ for items that are finished goods. So next, let's talk about Reorder Point. Reorder Point is a very simple model that several companies use. It's really looking at the average usage of an item and the lead time associated with that item. So there's a trigger in the system that says we need to order this item once it hits a certain level. So if you typically have 30 of a particular item in stock and you set your reorder point to, let's say, 11 because you have a 3-day lead time, every time your stock gets down to 11 in the system, it's going to trigger a reorder point and send that order to your supplier to restock to that level of 30. And if you have a short lead time, that would be ideal. Now, if it's a longer lead time, you may not want to wait until you get down to, let's say, 11. Based on the consumption and how often that product or item is being ordered, you may have your reorder point, let's say, at 20. Because by the time you receive the inventory based on lead time, you will probably be down to about 11. But the reorder point is a real easy way to make sure that you keep certain items in stock without having too much inventory. For example, in my house, when the bread gets to a certain level or the milk gets to a certain level, a reorder point is triggered internally, right? Because those are items we don't want to run out of. However, we don't want to buy a ton of milk and bread because they're perishable. They have expiration dates. So that's another reason a company may not want to order too much inventory because the inventory could actually have an expiration date. And the reorder point is one way that companies can combat that. Next, let's talk about ABC analysis. So the ABC approach to inventory is just categorizing your items based on importance from A to C, with A being your most important items and C being your least important items. Very closely associated with what we call the Pareto principle, right? The 80-20 rule, where 20% of your items may account for 80% of your revenue. So companies will take their items and then they will classify them either A, B, or C, with your A items being very, very tightly controlled and making sure that the records are accurate. For B, these are also tightly controlled, but not as much as A and a little more than C. Records are good, may not be as accurate as A, but again, very tightly controlled. And then C, this is probably going to be most companies' biggest category, where you have less control and less importance related to accuracy around the record. So companies do this because your A items are going to be your money movers. These are going to be the items that bring in the revenue, and they're also going to be the items that you spend most of your money on when it comes to producing or acquiring anything associated with those items. That's why you want to keep them in a different category, to keep a specific eye on them, or to make sure that I's are dotted and T's are crossed. And then as you get to your B and C items, you just have least or lesser importance when it comes to those items, because think about it, a lot of these companies have huge SKU assortments. They have tons of items that they have to deal with. So that A-list item, if it's 20% of all of the SKUs, what if this company have thousands of items, right? So there's still a lot of items that can be in that A-list category, but the A-list items are usually most important, brings in the most revenue, again, also costs the company most of the money to spend when it comes to actually producing an item or purchasing a finished good. So next we have vendor managed inventory. Vendor managed inventory is exactly that. It is when the supplier or vendor manages the inventory on the behalf of the customer. And in this case, this is a business-to-business relationship where one is the supplier and the other is a customer. Let's say a Walmart Coca-Cola relationship. So if you've ever been in a Walmart, you may have seen the Coca-Cola guy restocking the shelves, vendor managed inventory at play. And the only thing that Walmart has to do is share their point of sales data with Coca-Cola. And that lets Coca-Cola know where the inventory levels are for certain stores. And then they can take that data and know exactly where the replenishment levels should be based on whatever standard or guidelines that have been set. So instead of Walmart spending overhead costs on having employees to manage that inventory, they allow Coca-Cola to do that and set up something contractually where Coca-Cola will be able to come in and restock those shelves, and then Walmart fits the bill. And that's simply how it works when it comes to vendor managed inventory. Now, the other piece we can look at here is what we call just-in-time inventory. Now, just-in-time is much broader in scope than what I'm about to discuss here, but I want to introduce you to the concept. In the inventory sense, it is simply that, receiving inventory just in time when it's ready to be used in production. The benefit of just-in-time, again, going back to ordering cost and holding costs, you never have a ton of inventory tied up on the shelves. Right? So a good approach for your A-list items would be a just-in-time approach, because then you won't have to worry about spending a ton of money just to store that inventory. And in some cases, those A-list items may happen to be the bigger items, which take up more storage, which again increases your holding costs. So just-in-time inventory arrives just in time when it'll either be shipped to a customer or used in production. Now, with that, we have just-in-time too, very similar to vendor managed inventory. So, but instead of the retail space where vendor managed inventory take place, just-in-time too, beyond the broader scope of just-in-time, is when the relationship is strengthened between the supplier and the customer. So Walmart and Coca-Cola wants to have a better relationship. So they follow just-in-time too guidelines. And they don't just have vendor managed inventory on the retail side, they have vendor managed inventory or just-in-time too on the distribution side. So Coca-Cola says, we're going to have one of our employees work on site at Walmart in their distribution center to manage that aspect of the inventory as well. So on one side of the spectrum, you have distribution, then on the other side, you have retail. When it comes to retail, and the vendor or supplier is managing the inventory, it is considered vendor managed inventory. On the distribution side, where you have an employee dedicated to the customer, let's say again, a Coca-Cola employee working in a Walmart facility, that is considered just-in-time too. So, key takeaways. EOQ and EPQ are simply models that are used to balance ordering cost and holding costs. EOQ is specific for finished goods, and EPQ is used for items that will be used in production. The reorder point is simply a model that looks at the average usage of an item and considers the lead time to establish a point in the system in which the system should trigger another order for the product. ABC analysis is just a way to categorize your inventory so you have your most important items, your A-list items, tightly controlled with accurate records, and then B and C being less controlled and less accurate record. And then vendor managed inventory is when you have the supplier or vendor manage the inventory on behalf of the customer. And again, in this case, this is business to business. And the only thing the customer has to do is share their point of sales data with that supplier so that they'll know what the replenishment levels should be. And then we have just in time. Just in time is simply receiving inventory just in time to be shipped to the customer or received just in time to be used in production. Just in time too, a concept that is beyond the scope of just in time, where the relationship is strengthened between the customer and the supplier.